Hello traders, great to see you all again. Today we are going to talk about a trading method that has truly benefited me, how to catch major market trends amid all the complexity. Honestly, in my first few years of trading, I was constantly frustrated by short-term fluctuations. By the time I realized what was happening, major trends had already started, and I could only watch others profit handsomely. Later I discovered this JoJo long trend strategy. While it is not a guaranteed winning system, it has helped me make sense of the market. This strategy cleverly combines a multi-dimensional cloud system with a classic momentum indicator, like having two experienced mentors by your side, one showing you the big direction, the other suggesting entry timing. I am not exaggerating when I say this system helped me avoid countless bull and bear traps during last year's big market moves. Whether you are a beginner or a seasoned trader, this strategy is worth exploring to help you find direction in the turbulent sea of cryptocurrency trading. The JoJo long trend strategy is essentially a filtering system that helps you see the big picture. Let me give you an example. While most people are still agonizing over Bitcoin's short-term ups and downs, this strategy quietly tells you, hey, the major trend is already up. Do not worry about these small fluctuations. The core idea is actually quite simple. Use the Ichimoku Cloud to determine price position, confirm momentum direction with MACD, and verify the major trend with long-term EMA. A three-pronged confirmation approach. Only when all three indicators agree do we have a genuine signal. I particularly like how it combines different philosophies. The Eastern Ichimoku focuses on space and balance, Western MAC specializes in momentum and timing. Plus the classic long-term moving average for major trend confirmation, truly taking the best from different approaches. During the bull market when Trump took office earlier this year, when prices broke above the cloud, Massachusetts CD showed a golden cross and stood above the 200 EMA. I entered with a large position without hesitation and made substantial profits. The dynamic ATR stop loss and take profit in this strategy is also my favorite, as I do not need to stare at fixed price levels. It adjusts completely with market movements. To be honest, it is not suitable for those seeking short-term excitement. But if you want to profit from major market moves, this is the tool for you. First, let us look at the strategy parameters. The Ichimoku Cloud uses 9, 26, and 52. These are not random numbers using days as the period. 9 corresponds to a week and a half of trading days, 26 is about a month, and 52 is a quarter. I was skeptical about these parameters at first, until I witnessed their accuracy in Bitcoin movements and became convinced. MACD uses the classic 12, 26, and 9 parameter combination, which needs no explanation. I have tried various optimized combinations, but found that in crypto markets, these seemingly ordinary parameters actually provide the most stable results, especially during high volatility periods. They are neither too slow to miss trends, nor too sensitive to generate false signals. As for the 200 EMA, it is quite interesting. I used to think moving averages were not special until after repeatedly getting trapped. I realized only long enough periods are effective enough. Price above the 200 EMA is not just a technical phenomenon, it represents a shift in overall market psychology. I remember at the end of last year's bear market, when Bitcoin finally broke through the 200 EMA, I immediately switched to a full bullish approach, which helped me avoid numerous short traps afterward. The brilliance of this strategy lies in how three indicators work together. They are like guards positioned at different spots, jointly monitoring every market movement. Initially, I had a superficial understanding of the Ichimoku Cloud, treating it as just an ordinary support and resistance indicator. After deeper research, I discovered it is a 5-dimensional market scanner. The cloud itself forms a price activity zone. When price is above the cloud, it is like a sunny day, good for going long. When price is below the cloud, it is cloudy. Consider going short. Inside the cloud is like driving in fog with low visibility. Better to wait. Once Bitcoin struggled within the cloud for a whole month, I almost could not resist opening a position, but thankfully followed strategy discipline and only entered when it truly broke above the cloud, avoiding unnecessary troubles. The MACD indicator may seem old-fashioned, but it is excellent at confirming trend momentum. Its brilliance lies in filtering out short-term price fluctuations to capture real momentum changes. I have observed countless times that when MAC shows a golden cross while price breaks through the cloud, it often marks the beginning of trend acceleration. The 200-period EMA plays the role of a major trend gatekeeper in this combination. It moves slowly but is most reliable. During the worst of last year's bear market, strictly following this moving line's guidance helped me avoid the disaster of going against the trend. These three different types of indicators combined are like multi-layer filters that screen out most market noise. I have done statistics. The cloud alone has about 60% accuracy, adding MAC increases to 75%, and with EMA filtering it reaches over 85%. Although signals become fewer, their quality improves dramatically. Is not this exactly what we traders dream of? Honestly, I am deeply impressed by the clever design of these strategy conditions. First, note the bar state is confirmed condition in the code. This is extremely important. I still remember the painful lesson before using this condition. Rushing to place orders before a candle was complete, only to see prices suddenly reverse and get trapped. The rapidly changing volatility in crypto markets can really catch you off guard. The triple filter for long positions is particularly strict. Price must be above the cloud, close greater than leading spana, MAC must show a golden cross, mag line greater than signal line, and price must be above the long-term trend line, close greater than long-term EMA. When I first used this strategy, I thought it was too strict and missed many seemingly good opportunities. Until later I discovered that those opportunities that did not meet all three conditions were mostly fleeting. Last April, when Ethereum met all three conditions, I finally got a perfect signal. Although it had already rebounded 15% from the bottom and looked a bit high, I still entered according to the strategy. The result was continuous growth with another 40% rise. That is when I truly understood the power of this strategy. Better to miss than to be wrong. The short position conditions are designed even more strictly, requiring a break below the lower band of the cloud, close less than leading spam, which is more demanding than long conditions. This also fits market patterns as cryptocurrencies are generally in a long-term uptrend, so shorting requires more caution. Exit conditions are relatively loose, which is another clever aspect of the strategy. Strict on entry, but once in, give the trend enough room to develop. I remember going long on BTC a couple years ago, watching the profit grow but not yet hitting exit conditions. I was tempted to exit early. Fortunately, I stuck to the strategy discipline and ultimately gained 20% more than expected. This taught me a lesson: entry is technique, exit is art, and art requires patience. The strategy execution part is also worth learning from. ATR-based stop loss and take profit may be old school, but they are effective enough. I remember a big BTC drop when volatility suddenly soared. Fixed stop loss points could not handle it. But dynamic ATR stops perfectly adapted to this change. Thanks to the 1.5 ATR setting, my losses were kept within an acceptable range. The 3 ATR take profit setting is even more brilliant. Once when I went long on Ethereum, the market suddenly exploded, rising 25% in 3 days. Traditional fixed take profit would have triggered early. But with ATR dynamic adjustment, the take profit line moved up accordingly, letting me ride the entire uptrend. That trade return still makes me nostalgic. The 2-to-1 risk-reward ratio was also a major turning point in my trading career. Previously I traded with 1-to-1 or even lower ratios, resulting in difficulty making profits even with a win rate above 60%. After adopting this strategy's 2-to-1 ratio, even with a win rate of just over 40%, I could still make steady profits in the long run. This made me understand a principle: trading is not about being right every time, but about making more when you are right and losing less when you are wrong. What I like most is this clear execution logic that requires no subjective judgment. In the volatile crypto market, emotions often dominate decisions. With this system, no matter how crazy the market gets, I can execute calmly. This change in mindset might be the most valuable gift the strategy has given me. Do not underestimate the visualization part of the strategy. These simple markers have helped me tremendously in real trading. Those green up arrows and red down arrows on the chart are like signal flares on a battlefield, clearly indicating when to act. I have to mention again how important the bar state is. Confirmed condition is here. Without this condition, temporary signals would appear while the candle is still forming, and might disappear when the candle closes, driving you crazy with these flickering false signals. With this condition, signals only display after the candle confirms its close, greatly reducing interference. My personal experience tells me this strategy performs very differently in various market environments, making scenario selection crucial. The early bull market is absolutely the golden application period for this strategy. Last November, when Bitcoin started breaking through major resistance levels, the strategy gave clear bullish signals. I remember many people were still worried if it was just a rebound, but the triple confirmation system gave me enough confidence to enter with a large position. I held that position for nearly 3 months with profits exceeding 40%. The key was that the entire process had almost no drawdown, letting me sleep soundly at night. Interestingly, this strategy is equally effective for shorting in clear bear markets. When the crypto market began to collapse in early 2022, after prices fell below the cloud, Massachusetts CD showed a death cross and fell below the 200 EMA. The strategy gave a short signal. I hesitated a bit but still shorted Ethereum according to the plan, and in the next 2 weeks Ethereum dropped 35%, with returns from this trade making up for several previous small losses. But honestly, in sideways consolidating markets, this strategy is simply a disaster. I traded frequently during a consolidation phase in mid-2022, and took 5 consecutive stop losses. The market was like a child without medication, going up and down unpredictably, with apparent breakouts quickly reversing, causing the strategy to generate many false signals. Once a friend asked why I did not adjust parameters to adapt to the consolidation market. I told him, "You cannot have your cake and eat it too." Over-optimizing for consolidation periods might miss the real trend initiation. Rather than pursuing an all-purpose tool, it is better to use the right tool at the right time. The most practical tip is to combine analysis with higher time frames. I usually first look at the overall trend direction on the weekly chart, then use the strategy signals on the daily chart to determine specific entry points. Last July, the daily chart once gave what seemed to be a good bullish signal, but the cloud on the weekly chart still showed a bearish alignment, so I ultimately chose to wait. This decision proved correct as the market subsequently fell by 15%. Regarding ATR parameter adjustments, I found that during extreme volatility periods, such as after major positive or negative news, adjusting the ATR period from 14 to 21, or even 28 would be more prudent. This reduced frequent stop losses caused by excessive volatility, allowing the strategy to better adapt to temporary market anomalies. Remember, there is no perfect strategy. The key is to find a tool that suits your personality and trading style. As my trading mentor often says, successful trading is 80% psychology and 20% method, and this strategy happens to give me enough psychological security. As someone who has used this strategy for nearly 2 years, I want to share my honest evaluation, neither exaggerating nor understating. Regarding completeness, this strategy has built a self-contained trading framework. It has clear entry standards, specific exit conditions, and reasonably designed stop-loss and take-profit levels. I particularly appreciate its triple confirmation mechanism, which greatly improves signal quality. But honestly, the lack of a money management module is a pity. I remember once after consecutive profits I became overconfident and entered with a full position, only to face a market adjustment and suffer significant losses. If the strategy could automatically adjust position size based on win rate, it might be more complete. Risk management is a highlight of this strategy. Dynamic ATR stop losses helped me avoid many big drops during the bear market, especially during the flash crash in March 2022. Thanks to this mechanism as a safety net, or the losses would have been more severe. However, I found the strategy lacks overall risk exposure control, such as automatically reducing position size or pausing trading when account losses reach a certain threshold. This would be useful when consecutively misjudging market direction. Regarding adaptability, frankly speaking, this is the strategy's weakness. It performs excellently in clear trending markets, but struggles like a fish out of water during sideways consolidation. During the period when BTC was oscillating around 70K from March to May last year, I took quite a few stop losses. The strategy lacks the ability to automatically identify market states and adjust parameters, requiring traders to supplement with their own judgment. Understandability definitely gets 5 stars. Friends often joke that I am too complex when analyzing markets, but I can explain this strategy in 3 minutes. It uses mainstream indicators without complex formulas. Even trading beginners can quickly grasp it. It is precisely this simple and clear logic that allows me to execute it consistently without doubting the system under pressure. In terms of innovation, it is admittedly average. It basically combines existing classic indicators without groundbreaking analytical methods. But then again, trading is not academic research. Practicality trumps innovation. Those seemingly cutting-edge complex algorithms often cannot withstand market tests, while these classic combinations prove more reliable. Finally, regarding practicality, I give it 4.1 points. The strategy is simple and intuitive to operate, with clear signals and good real-world experience. The dynamic stop-loss and take-profit design considers practical needs, and the code structure is clear and readable. The only regret is that it does not include built-in position management suggestions, requiring users to supplement this logic themselves. Overall, the JoJo long trend strategy is like a hiking stick, not the sharpest weapon, but very useful in the right context. It is particularly suitable for traders who seek certainty and are willing to wait for high-quality signals. If you are a thrill-seeking short-term trader, you might find it too slow and boring. But if you hope to achieve steady returns in major trends, it is definitely worth a try. I hope my sharing helps everyone. If you make money using this strategy, do not forget to come back and share your story. On the trading journey, let us learn from each other and grow together.